Understanding market structure and liquidity is the key difference between random trading and smart money trading. In this video, I will break down how price really moves, not randomly, but driven by liquidity and market structure shift. If you have been struggling with fake breakouts, stop hands, or entries that keep failing, this video will change how you see the chart. Let's focus on the left here and try to get our way to the uptrend, because I want to focus on an uptrend in this video. I already did a video that focused on the downtrend. I'll be uploading that video tomorrow. We start here by identifying this low here, which I already did, as a major low because it took out this liquidity here. And we created this high here. This high is not valid until this low is being broken. Now, if this low is broken, as we have seen, we mark this high here as our major high, and then we have to also mark the high that has been able to take out this major low here, which we have marked. If we draw a line here, we can see this is the high that caused the break. That high becomes our liquidity. So we mark this as our liquidity here. So this now becomes the liquidity. We will have to wait for market to trade back into that high. Immediately that high is being taken out. Now you have to what? Get ready to enter the market. In this case, market took it and went straight to the what? The major high here, which you have gotten some kind of confirmation entries here and be able to take the trade and put your stop just above that. Now we can see price didn't trade through. This was a sell structure, but price did not trade through. The intent was for price to continue to come all the way down here. Your first target should have been this, but price didn't trade through. This could have been some kind of break-even trade, or you could have booked some partials and allow it to run. But it did not trade through and went all over back again. Now, price left footprints that you could read and understand that this could happen. One is here, it has dropped liquidity into this high. These highs, this high here and this high here, now becomes relative equal highs with liquidity lying on top of it. I will be talking about these two in some videos coming later. This is the first indication for you to know that price can come back anytime to sweep this, and you see how they normally do it with momentum. Another thing is, if you understand direction, you will know that this is a potential turning point. Hence, it will help you to know that, okay, the market can reverse here. But in the beginning, don't still try to be catching moves like this. Wait until this high is being taken out. If that high is being taken out, then that's confirmation that there is shift in structure. Hence, the market is now going to start trading from what? Downtrend to uptrend here. That will help you to be able to get the next move that will come. If we look at it here, let me explain something here. You can see I marked blue with blue marks here, and then there was liquidity here. If you are following what I have been saying, you will not be able to identify this liquidity. Why? We are in M15. If there is structure that is going to happen here, then that means that it will come within a time frame that is below M15, normally M5. So within this fractal here, price has to pull back all the way here. This pullback is a small trend in the lower time frames. Hence, you can only be able to see it clearly in the lower time frames. So if we go to M5 here, if we go to M5, we want to be able to identify that structure again and then be able to understand where price will come back to. If we look at this place, we can see we identified this high here as a major high after taking out this low, created this low here. We identified this as a major low after it has broken this high. Now, the low that has broken this high becomes our liquidity. Let me mark it with a line so that we can see it very clearly. If we put this line here, you can see that the break came after this candle, and the low that caused the break is this one, and that is the liquidity. But why did the market decide to use the lower time frame liquidity? That is because neither this high nor this low was broken. Hence, it's going to use this structure. Always remember, you identify the liquidity only after this high has been taken out, or if it had come down like this, then that would have been this low. Then you will look at the high that took it here, and if it takes this one too, then you look at the what low that took it. But this didn't happen. It came and used this trend here, which was some kind of a pullback, to trade to this structure here. Hence, they had to use this internal liquidity to be able to continue the move to the upside. Hence, that was the reason why we had to use this liquidity from M5. And you can see I have applied the same scenario to be able to identify it. Now that market has shift in structure, we want to continue the uptrend and see what happens. From here, things are now even going to get much easier. In this case, you are not focusing on this high, you are focusing on your major high here. And we can see that high got broken. As it got broken, we want to wait for it to create this high and this low here. And the question you have to ask yourself is, which low broke the high? This was the low that broke the high here. This low broke the high, which is this high. Hence, this low becomes our liquidity. The market creates this high and comes all the way to the liquidity. From this point, you can find your entries here and take it to the upside, targeting this high that is here. Now, after this high is being broken, you need to find your liquidity again. If we pick this line again, put on top of this high here, we are looking at which high has caused the break. This is the low rather. This is the low that has caused the break. But look at something here. This is also something for you to understand. And I will be doing more videos like this because I get the chance to explain things that will let you be able to understand things in specific scenarios. This was our liquidity. And you see how the market obeys it always. After it has taken the liquidity, it taps into this place like this, and then we trade upward. Even you could have taken this trade, and after this high was taken out, push, you could go to break even. This could have been a break even because you were targeting here. But I would not even have been focusing on this trade. Why? Because the market needs to pull back into some premium levels here. If you draw like this from this high to this low, the midpoint of that was somewhere here. You don't want to be taking the trade up here. Sometimes it can continue all the way, but it will still come back to this liquidity. But how do you identify this liquidity? You can see that within this big structure here, within this big structure here, we have this structure, which I already identified with a blue. This low took out this high here and created this high, which also came down, and then we push. If we want to look at what happened within that structure, this is structure within structure. We put another high here. Now, which low has broken this structure to the left is this low. This low now becomes, this low here now becomes our liquidity because it is the one that broke this structure that is within this whole structure. There was some kind of two forms of major liquidity within this range. Hence, the market picked this one, move up, came for this major one, and then the real move came. Now, we identified this high after it has taken out this low, and we wait for this high to be broken. If it is broken, we have two things to do. Identify this low, which the lowest low it has created, and then we have to identify the low that caused the break, which is our liquidity. Hence, this is the low that caused the break, and that becomes our liquidity. Price trade back into it. As we can see, these are always the most simplest trades because this is the only low that was here. So there is no confusion like in this case. The market comes back to it, tap right into it, and then push to the upside. This is how you have to be marking your market structure and then liquidity. So pick this high here. If we put it here, we can see this was the low that caused the break. This low becomes the major low. Now we have to put this high on. We have to put this high here again, and then this low becomes only valid after this high was being broken. Now, which low has caused the break? If we trace price down, and normally I say the tracing of price, follow the candlestick, just the white ones, you trade it, and if you get to a high like this and this, always use the highest high. You are following the white candles, but you want to identify, stop at the highest high here. You see the white candle stopped here, this bullish candle, but it went all the way up. The reason is that this sell candle, when it opened, it went all the way up first before coming down. You want to follow it like that. Now we trade all the way back down here, and then we push price to the upside here. This was the low that broke this high, hence that becomes our what? Liquidity. Now this is always the most interesting part, because market never came back to it. Market didn't come back to it, and they continue the move. You want to always be aware of this low, this liquidity that market leaves without coming back to it, because this kind of trades are very good, and they are always with high risk to reward. If we come back here, we can see market came back and tap on it and then push to the upside. If we measure the pips, gold has been very volatile nowadays. It went up almost 800 pips before coming down here. And this is the live market. This is what is happening on 2nd April today. Check the charts, you'll be able to see it. I'm using the live market, what has just been printed. But let's continue from here. Now, there is something you need to understand here. After this high was being taken out, let's follow what price, the foot price. From here, we created that. We created this. You don't mark here because this is within this high and then this low. Then we created this. We created these small ones. Since this candle didn't take out this candle, just leave all this. Move to the up here and then we come down. This particular place, high and low, was hidden, but if you draw, you'll be able to understand it. You can see that we didn't mark any of these lows as major lows or major highs because price was not able to pull back to take any high. So this is still nothing. This is always liquidity. Price is dropping and it will come later to take it. You only mark it after a high has led to take this previous low here. You are getting interested. If we follow this price here, follow the red candles down. Now you can see white candles has started. These are the bullish candles. We push to the upside here. And then price trade back down. You see, it's very important for you to understand that. See how this has just taken this low out, and that was the point that you have to pay attention because the low has taken out. It looks ugly, but that is the theory. We want to see something like this. We create a low. You want to see them come back to take that low and then push up. That is where you are interested to mark this low as your major low. And here is the same thing. We push up and then this price here came down to take this low up and then push up. You want to mark those highs and lows as your major highs and lows and be able to identify the liquidity. If we look here, price took it out and then created this. You want to mark the high that led to this liquidity being taken out first, and when that high gets broken, then you want to mark the liquidity and then the major low. From here, price traveled down here and then created this low here that was able to break this high that was here. Now this low becomes our liquidity, and this low, which is the lowest low, becomes our major low. Then price trade back into the liquidity. Very nice confirmations there, and then push to the upside. our target would have been this high here that it created. Now, this high also becomes valid. I already told you, because it's like this, up there, and then it comes all the way to take this low out. Hence, this high becomes valid, and we wait for it to break. If it breaks, that's where we are getting interested to identify the low that caused the break. Hence, this low becomes our liquidity. You can see market didn't come to that low before they created another valid high. You have to mark the liquidity but continue the structure. From here, market created another high. If we follow the price from here, it created some low like this, went back, came back to take that low out. We are interested in that high that has caused that. And if that high gets broken, we identify the liquidity that did that. This is it. This is the low that caused the break of this high here. Hence, that low becomes our liquidity. We can see very well market came back into that. After taking that low, they tap into this support here. We will still talk about the SNR part, so you will be able to understand after the liquidity is taken out where they always tap into. So from here, they tap into this support because every buy, every sell starts from a support and resistance. Now we are combining the liquidity. So we tap into this support and then we buy back up. And this is the high that was able to lead to this liquidity being taken out. Hence, that becomes the high we are interested in. Now, if that high gets broken, we want to identify the low that caused the break. This is the low that caused the break. That becomes our liquidity. We can see from here price reverse again, but even if we look, you can see very well how price has been able to what? React to that liquidity, tap into these lows here, and then push back before the break comes. This is normal. If price is always going to reverse, this will happen. They will fail some of these liquidity lows because all of them are liquidity and they left them on purpose. This one, this one, this one, you can see how the red candles came. This is all because of these liquidities that were left. And why did they do that? Because of this whole liquidity, big liquidity pool they left here, and they came right into it. Immediately they take that liquidity. We are seeing a reversal. From this point, we continue. We were here. We identify the low that caused the break, which was this, which becomes the liquidity. Now we push to the upside. This high becomes a valid high. Why? Because if we draw it like this, it goes up, comes down, goes up like this. It takes out this low. That makes this high a major high. We wait for it to create this low. If this high gets broken, we are interested in the low that caused the break, which becomes our liquidity. Here, market didn't even react to this. It just blew it, came to this, react small. This reaction is also on purpose for people to get in and then they smash them more. Why? Because of this liquidity that is here. They are coming here. Anything here becomes liquidity. And you need to always understand where the market starts to trade and where it can come back to. If we combine this with the higher time frames and tensions, you will always understand where to wait for market and what to do as at that point. This is it. From here, market reverse now, and we can see it took out all this liquidity. And I will still do a video on the types of liquidity so that I'll be able to explain to you, because even the major lows you are seeing, which we have identified here, are also what? Liquidities. But you need to understand how they are being formed. These liquidities, when the market is done with it, when the market has completed the intention of creating it, you need to understand when not to use them again. And always after the reversal like this, all this becomes liquidity. Because mind you, when we were buying here, our stops were also there, and they understand that. The market knows that. When we were buying here, let's say we were buying here, they know our stops were here. When we were buying here, they know our stops were here. So they will still come back for all that. That is why if you understand how to trade short term, it's going to be very, very profitable. But if you don't know and you want to keep this for always a long term, then it becomes a problem. If you want to do it long term too, you need to know where and when to get out. This is it, and this is the current market condition for gold. I'm doing this on 2nd April, so you should check the date. You can see here, this is Thursday, 2nd April. I'm doing that. Follow what I have done. Try to see if you understand how I have been able to market. And I just mark them always first so that later I can be able to explain them to you clearly. But later on, I will still do some videos with only back testing where we'll be playing price one by one, and then you can be able to see it break. The one that caused the break we identify, and then it creates a high, it comes back. We will do this in back testing too, and you'll be able to understand what I want to let you understand much better. This is it. I'm dropping more videos on the liquidity. I think we still have trendline liquidities, major highs and major lows liquidity, which is the external liquidity. We have relative equal highs and lows. I will do a video on that, and then we will see what we'll be doing. If this video made sense to you, drop a like, share the video, and subscribe to the channel. Let's push this knowledge I'm dropping. You cannot find it anywhere. Some of these things I discovered them myself, so they are not anywhere in YouTube. I haven't found them myself. Take your time, understand it. When we combine this with SNR, it's going to be very, very lovely, and I cannot wait to continue the journey with you. Peace out.